presentation that I've now seen Alioune do 3 times in the last few days. We're going to have a little bit of a conversation about fund structures. So I'm going to ask each of our panelists to quickly introduce themselves. I've got a few questions. We're going to make this nice and short, but hopefully pretty insightful. So, Ido, why are you on the stage?
Because Christoph invited me, but otherwise I spent the last 19 and a bit years on the intersection of Africa and tech, 15 years in VC, and currently thinking about what's next for me, but some experience in the space for the last few years.
Maisa?
I'm here because I was threatened. No, just joking. I'm here because my good friend Alioune kindly invited us to speak about this topic, and I think it's a very relevant topic for what's going on in the ecosystem. I'm currently the head of Africa for venture capital at IFC, the World Bank. So looking forward to the discussion.
Alioune, I'm pretty sure they know why you're here.
Yeah, I spoke a lot already, but mostly to push people to speak and to challenge the status quo, essentially.
Yeah. Excellent. We can do that from both sides, but I mean, we've got a pretty, I think, pushable panel here. So I think one of the things, Alioune, that's great about the research is that it opens up a wide variety of options for fit-for-purpose capital. So if we were to go back or forward in time and redesign the Silicon Valley venture model in Africa, what would we keep and what do you think we would leave to the side? Ida?
I think we may end up in a few years in something that is not necessarily different, but for where we are missing a bunch of components, and as such, I think that we are using a model that doesn't address a lot of them, and by a lot of them I mean the nature of the capital. So the capital, we use equity for everything,
right,
which is nice, but also very expensive and pushes price up very early. We get very little flexibility on the in and out,
yeah,
because we have lack of liquidity at the end, and we are struggling to tie incentives between the providers of capital and the students of capital in that regard. So I would have in mind that something different. It's also said that funds in their current structure cannot work, but I would think slightly wider to address those gaps.
Absolutely. I say you've spent some time in the US as well, in the ecosystem. What do you think?
Well, I think the conversation around the instrument is spot on, right? We need to basically be equipped with the tools to do what we're trying to do.
Yes.
But something that I would have changed is also the way we engage with the ecosystem. And when I say we, it's investor to company. Because there's always been talks about unicorns. Let's chase the next unicorns, and unicorns will drive exit. But Africa is not a unicorn market. It's an SME market, right? And when you draw conclusions and you draw parallels with other markets, it actually is the same. What is the driving base and value of growth and prosperity are SMEs. So maybe our venture capital models should be built around how to optimize SME value versus chase unicorns.
I completely agree. Something that I often say is that, instead of chasing unicorns, we should be building gazelles and zebras because they actually exist. Like really. And here, they do.
Yeah.
Yeah, Alioune.
Yeah, no, absolutely. We've touched on it. And I think what comes up of the research also is that there's actual appetite from fund managers to do things differently.
Yeah.
When you actually challenge them and ask them to, pause on what they've been doing for the last couple of years, they actually do innovate and they actually come up with fund structures that are fairly interesting and definitely that look at least better fit for purpose. But of course, there's also pushback, right? Because it's good to come up with the concept and the idea, but you need to be able to raise for the product. And we also have a lot of work to do at that level, and push LPs, institutional LPs, to support and adapt the change that is required and that is requested from fund managers.
Yeah, yesterday we did a roundtable with LPs, Alioune and I did, and one of the, I think, pieces of feedback that was really interesting was around changing the narrative of alternative funds to you should give us more time because, you know, it's harder to do things. We need more time. You need to be more patient, to here's the value you can achieve if you give us more time and a broader toolkit to do that. And I think it's good feedback because, you know, LPs do not owe GPs anything, but it's up to GPs to make that value creation. So, you know, as you're thinking about how potentially other markets that you've seen have do that, what would be your advice to fund managers thinking about that?
I think that, you know, the patient's capital thingy is a bit of a pile of crap. In other words, no one wants to get lower IRR over a longer period of time. That's a non-offer, right? Let me give you less over more time. It's just not a very attractive offering. So the patient capital can only be patient if it can do, you know, if it pays either a much higher IRR at the end or otherwise starts generating revenues earlier on through using, again, debt, working capital facilities that spit out interest and so on and so forth. But just being patient, I mean, yeah, that's charity, which is a great business, but it's not ours. So I think that is a bit of a confusion that we tend to stick to and maybe need to part with, because it seems like LPs are not that interested in it as well.
No, absolutely. I said, what have you seen from so I'll tell you that I know that multiple of the big DFIs, particularly ones like IFC that have been in the market early, are sitting on year 14 with a lot of the funds that they've invested in. So what would is there something that the fund managers could have told you up front that would have convinced you to let them have a 15-year fund instead of a 10 plus 1 plus 1 plus 1 plus 1 plus 1 plus 1?
I think it's always a good thing to look at data and things in perspective. Today we're saying it takes a long time to return capital in Africa, but do you know what's the average time to return a venture-backed unicorn in the US?
No.
It's 10.6 years.
That's for unicorn. Fund ages in the US is 16 to 20 these days.
Yes, he said it. So this is not an African problem.
Yeah.
It is a characteristic of this asset class. Now, once we've moved past this self-pity feeling, to be honest, of saying we need more time because we're special, we're Africa, you actually look at why do we need more time and why is it acceptable in the US that it is a 10 plus 2, but in reality it's 16 and they don't complain about it, but we do. And a lot of that conversation comes from the realization that investment is a life cycle. And your LPs will be okay with that as long as they see value in that life cycle. So for me, the whole conversation around extending life cycles of investment, African funds, is a non-starter. It's not going to happen. As you rightfully said, if I'm an LP and I'm getting money somewhere else with a shorter life cycle, or I'm getting it with the exact same life cycle, but I'm getting more, then why am I compensating an African GP to give me less?
But I don't think that's the request. The request is, I think, for many of these funds, and again, the thing is you're not getting it elsewhere. You're sitting in these funds at 14, 15 years across different life cycles. I just happened to have taught a course for 40 of your fund managers in May, and I know that many of them are far past their 10-year. So you aren't necessarily getting it, but you're asking for the optionality. And I think this is where the conversation gets interesting around value creation. I completely agree with you. And this is where I think, Alioune, the work that you did was really important because it's not just longer, because just longer on its own is not compelling. But what if our fund managers told you that in order to build gazelles and zebras, we need a longer fund with multiple tools? Is that then compelling for you?
Well, we're already giving it to them.
So, I mean, yes,
the concept of
that.
continuation funds, the concept of, recycling your assets, it's not new.
No.
But we also have to understand that, especially for DFIs, we have a fiduciary duty of returning capital, returning it efficiently and timely. So today,
But
if
that
I'm
timing
saying,
is
Let
made
me
up.
challenge you here, as I currently, am not on fundraising, so I can happily do that. You are not, right? So in so many words, you are probably the most constraining beast on earth as an LP. And I think that, there are constraints around what you can invest in. There are constraints that are very unique to the geography. There are constraints about how many boxes you need to tick alongside return, which are non-commercial boxes. But I think to your point of you're allowing, multiple tools and so on, you're not allowing it in the same fund. Let's not, confuse ourselves there. So you're allowing equity only in equity-only funds. Yes, you could do debt if you're a debt fund, and you could do venture debt if you're a venture debt fund. We don't have many of those in the region. But you're not allowing to a lot of flexibility with how, for instance, in the LPA, historically, you could only give a loan if it's sub 12 months at very specific terms. So you can't really play in that regard of creativity.
And I would also take umbrage with the idea that your mandate, as with the World Bank money that you have, is to create development, not to create returns for the World Bank. And it's not to create short-term returns, it's to create long-term development. And so this is I was speaking with one of your compatriots in a different fund that has a 20-year European Commission guarantee themselves, but will only do 10-year funds. And then pushing on that. Well, that's what we've always done. There's no actual, and I would say it's very similar actually for the IFC. There is nothing in law. You do 20, 30-year debt funds all the time.
So I think this comes again from the misperception of what is money for the World Bank. We have at the World Bank what is the EBRD, which is the Bank of Reconstruction and Development, which is our tool for grants, institutional support, public advocacy, and all of that. That needs funding. How is it being funded? Through donors. And we've seen increasingly that donors, which are countries, but they don't have the money anymore, or they don't have appetite anymore. And it's been the case, and it's even more the case now, that when this gap happens, it's the IFC, which is the private sector arm, which has to provide returns to fund these activities. So, yes, we are commercial. We're a commercially driven impact vehicle. So the same way that in the commercial world, people want return adequately within a timely framework, we want to. So now there's always a notion of patient capital. Patient capital has to be taken in the whole context of what the bank offers.
Yeah.
Meaning blended finance, long-term loans, which is not what we do in private equity.
Of course not.
And of course, equity returns, which are risk-taking investments. So they help basically cement and build the base of this ecosystem, which is a bit more risky, but it comes with the expectation of return. So it's a bit hard to want things both ways, meaning you want the patient capital and you want also IFC to take more risk and be more commercial. So there's a word in between, and I think this is where us, DFIs, sometimes we battle with the perception that our money has must always be patient across all of our verticals. For the venture capital practice, it is not the case.
Elian, you want to talk about...
I think I would like to reframe the discussion, because the fund managers we are speaking with are not saying that they want patient capital. They're saying that they want longer term in order to better align their fund economics with what the market requires in order to generate more liquidity faster for the LPs. So the conversation really needs to be reframing and not thinking in boxes. And I also push it towards fund managers as well, because it's not taking one item, changing it. That's not how you generate performance.
Yeah, absolutely.
We need to completely rethink the model. We need to innovate. And it's challenging, right? Because it's new. It's trying to find something that works out of something that doesn't work, and that will take iteration, for sure. But that will take also experienced managers trying new things, but they will need to be backed by commercial capital that actually want return, but that understand that in the way they're funding funds today, that's not return generating.
I think that's the key piece of it. I think that's the core, and I love that's what the conversation we're having is that, again, become like the original question is, it's about value creation. So saying to LPs, here's all the things you're looking for. we want to give those to you. But in order to do that, we need to build funds that look differently, because the constraints, and I think this is what came out in the research, the constraints that are put on there are actually impeding that ability to do that. And I think this is where that open conversation needs to happen, and it has to be, and I think it is, I completely push also onto the GPs to say to the LPs, not, I need this, you should give me this, because you can. More, you need these things, I want to provide these things to you, and this is what it looks like. And I do think there's the impetus to be able to show that this works. And I do think having experienced fund managers be able to do that. And I've heard multiple times from people say, I really want to design a fund this way, but it's my first fund. I know it's hard enough to raise, so I'm going to do it on the second fund. And that, I get that. That makes sense. Ido, how many funds has Telecom had now?
2 in Africa and a couple in Europe before.
So if you were to design a new fund now as your next iteration, what would it look like?
Probably smaller, so a few tens of millions, holdco structure with sub-SPVs for deals that allow me flexibility in the sense that I can do. So I think we've talked about it, but there is many times misuse of capital, which then pushes pricing and so on. So if someone needs 5 million, of which 3 are working capital, I would like to give 2 in equity and 3 in working capital, be able to retain the 3 in working capital with whichever interest, and most people would pay today 20 plus in dollars. So that means that within 4 or 5 years, I sort of de-risked my capital base. I can start paying out IRR, and then I have an upside. Of course, it's not for all business models, but theoretically, that's how I would think about it. Then also with these, if you build the business with the right capital structure, you can exit it at potentially lower number, and still everybody can go home happy. I think there's a separate something we have not touched on. How do you incentivize the potential buyers here, which are less so the Googles and Amazons of the world at this point, and much so the local conglomerates and groups, and how do you tie these incentives at the gate? But that's a longer, separate discussion.
And I think that ties into another discussion around what we talk about a lot is obviously mobilizing local capital, and that's something that the DFIs would love to as well, to come in and catalyze local capital. And I think, to your point earlier around if we're looking at gazelles and zebras as opposed to unicorns, that actually might be a more compelling case to some of these pension funds that understand their local economy. And I think, just to close, Alioune, do you want to kick us off? I'll ask each of you to just talk about what do you hope that in 5 years, if we're sitting on this panel talking about fund structures, what do you hope that we'd be talking about? What type of trends?
I hope we'll be speaking more about funds that do generate liquidity. To answer to the same question that you asked, Ido, I'd probably do a secondary fund. We'll go out and pitch to founders. You can get X million from me, pledge the shares of that you hold on your company, buy out your cap table, and I'll be paid out through dividends.
I love that idea.
So more liquidity generating fund structures, assets across the continent, definitely part of the mix.
Mesa?
I mean, I agree with you. I think it's a mindset. It has to be a mindset that shifts towards compounding value, because when you compound value, then your liquidity options expand.
Yeah.
That's when you can leverage structured exits. That's when you can actually tap into banks. That's when you create an ecosystem of CVCs. And it is all, again, a chicken and egg issue, but I think today what we want to see in the ecosystem, and is already happening, is GPs take initiative and say, okay, if we were a startup today, we are at a pivot point in our startup life. So we're seeing that being a bit more of a thinking venture, that we're seeing traditional financing solutions, aka SAFE, being left behind to come back to more structured instruments that provide alignment. So I think we're getting there. And the expectation that our ecosystem, which is exciting but new, has to get it right. Yes, early not broken, has to get it right now. I think is wrong. We still have a little bit of time.
Yeah.
Yeah.
Ido, early not broken?
Early, no broken. Yeah, I think, again, we get the early discount, but with that, given the things we don't have, which is government grants, R&D, credit lines, and so on and so forth, some of it will need to be incorporated into how we adjust the return and the risk into our investment vehicles. And I think that is a bit of a more holistic thinking process rather than just trying to fix for the one.
Excellent. I apologize, I am 25 seconds over, but I will close it out there. Thank you all very much.
Thank you.
Audience.